Welcome back to my YouTube channel. My name is Mtrades. You can also call me Dimeji. So today's class we'll be discussing key levels. We'll be talking about key levels, how to identify key levels. Basically, what are key levels? Key levels are vital part of trading. Very important when it comes to marking out, when it comes to analysis, when it comes to understanding structure. So we'll be discussing key levels in this particular session. So get your pen, get your journal, and let's go on a little journey. All right. So basically, key levels, you can also call them support and resistance. Basically, like straightforward, simple English. Some people call it key levels, some people call it support and resistance. It's the same thing. So master the basics, build the edge, trade with confidence. In our previous videos, in our previous classes, I explained how you can trade with confidence. How you can develop confidence in trading is simply understanding technical analysis, having a good psychology, and being able to execute your setups consistently. Right? So this is how you gather confidence, you build that strong foundation in trading. All right, so what are key levels? Key levels are areas where price has repeatedly reacted. They are places where buyers or sellers previously took control. Remember what we talked about in previous sessions? We said the market is a constant war zone between the buyers and the sellers. One is trying to take over from the other person is trying to dictate the major direction of the market, right? So key levels are zones. They are not exact lines. So this is an example. So we have resistance zone and we have support zone. So support are areas where buyers step in. They're usually found after a decline. So like simple English, support, like something is supporting price, right? Like let me say a floor level, like a balanced surface supporting something, holding it firm. So support areas are areas where buyers step in. They are usually found after a decline. Price often bounces from support, or it consolidates, or it starts an uptrend, changes the major direction of the market. So those are what key levels, those are what they do. If you mark it correctly, price tends to respect them when it gets there. Right? So it's like an institutional reference point where when the market gets there, it tends to either change direction, bounces from there, or it consolidates, or it starts another trend entirely. Resistance are areas where sellers become active. Remember, supports are areas where buyers become active, where they step in. Resistance are where sellers become active. They're usually found after a rally. So rally means when something pushes up, uptrend, rally, bullish markets, they are all the same thing. Decline, bearish markets, all of those things. All of those things are, you understand, they are all the same when we are talking about sellers there, right? So resistance are areas where sellers become active. They are usually found after a rally. Price may reject when it gets there, it may reverse, or it may start consolidating. In the previous video, I talked about the type of markets we have. We have the bullish markets, the bearish market, and a range-bound market. I discussed that in detail, right? So how to mark key levels? So key notes: price remembers areas, not exact prices. Those areas you mark on the chart. If you mark your support and resistance levels properly, those places are areas where institutional orders are carried out. So price tends to remember them whenever the market gets there. Oh, okay, this place was where so many sellers stepped in when it got here. Oh, this place was where so many buyers stepped in when it got here. So the market tends to remember those places, right? So how to mark key levels? You start from the daily time frame. This is how I mark my own key levels, right? This is how I approach the market. Each time I open my trading device to want to trade, to want to analyze the market, I go to the daily time frame. I look at the bigger picture, because when you're trying to trade on a very smaller time frame, you're trying to trade from the M5, M15 and all of those things, you're trying to mark those key levels from there, you understand, you might be getting the reading wrong. Like, you're not looking at the bigger picture, what the major order flow of the market is. So I tend to go to the daily time frame, mark my key levels from there, because those are the higher your time frame, the more accurate your analysis, right? So I find obvious swing highs and swing lows. So what are swing highs and swing lows? Swing highs and swing lows are areas where the market reversed, the turning point of the market. Swing high and swing low. Swing high and swing low. I'm going to show you examples in the next slide, once I exit this particular page now. So yeah, so I find obvious swing highs, I find obvious swing lows, I extend them to the right, and then I drop to H4 to refine those key levels. So this is an example here. Daily, I use it to mark my big picture, use it to mark my key levels, my support and resistance. Then I use H4 to refine those levels properly, right? So don't draw lines, draw zones. If you draw lines as your support and resistance, it will be too precise. So S and R levels, is the short form is S and R, or key levels. They are like zones. They are not tiny lines that you just put one straight line there. No, they are like zone. You mark the zone out, expecting reaction from that particular zone. You understand? So yeah, so this is how you mark it. This one is too precise. You can see just a tiny line is too precise. This is how you correctly mark your support and resistance level. This is a zone, you can see. So these are swing highs. Look at this high here. When the market came there, now this is a resistance. Resistance is doing what? Holding. Sellers become active at resistance. Buyers become active at support. So this is a swing, an example of a swing high. You can see the market rallied here, created a swing high, created a swing low. Swing lows and swing highs are reversal, where the market turned around. Sure, you understand? So this is how you correctly mark your zone, right? So strong versus weak levels. Strong levels, how do you identify strong levels that, oh, okay, this support level is very strong. I'm expecting buyers to actually step in once the market gets there again. How do you identify that? You tend to see multiple reactions, multiple rejections from that particular area. It will be very difficult for sellers to break through that support. When the market gets there, it's either it starts consolidating or it's just calm and silent around that key level. So multiple reactions, large rejection candles, higher time frame, high trading volume. So these are how you can identify strong levels on the market. How do you identify weak levels? By only one reaction, by small candles, by lower time frame only, and by low trading volume. So this is the difference between the two. Look at how price reacts when it gets to support. So the green line, the green zones here are denoted as supports. The red zone above are denoted as resistance. Resistance is like, let me say, ceiling. Support is like your ground floor, right? Yeah, okay. So how price reacts, you can see the market was declining here, was dropping, got to this support and started bouncing gradually. So it means this particular support level is holding. In a situation whereby the market gets to your support, bounces a little, and still goes back below the support to break through the support zone, you can expect the market to continue selling. You understand? Yeah, the market came to this support, consolidated a little, did like it wanted to go below the support, but started rallying again. This is a fake breakout. They call it fake breakout, right? This one is retest, then continue. So the market came to this support, came up here, went below the support, but didn't cleanly break below the support. And from the support area, started rallying again. Retest, then continue. Right, so let's look at a practical example of swing highs and swing lows are major reversal points on the market. So let me show you practical examples of what I mean by that. So let's go to trading view. And yeah, so I'm currently on a trade on Japanese stock market, Japan 225, type 4. So that's the model I'm using on this particular setup. So yeah, I'm in a tight settings on this particular one. So let's go to Euro USD. Let me show you how to mark key levels. Euro USD. Let's use FXCM. So on the daily time frame, like I said, I use the daily time frame to look at the bigger picture, then the 4 hours time frame to refine my key levels and to look for the trend, to mark out the trend properly, and before I start using my 1 hour time frame for entries, right? So yeah, so we said swing highs and swing lows are major reversal points on the market. So this is what I mean. So look at, this is where Euro USD is currently. This is the current price of Euro USD, 1.13875. This is where it is, right? Look at the daily candle. So it means in the next 10 hours 14 minutes this particular candle is going to close for Euro USD. Yeah, so look at the trend of Euro USD from here. So this market pushed all the way from here, pushed up, right? And since then it has been doing what? It has been consolidating. You know, we talked about 3 different type of markets we have. We have the bullish market, the bearish market, and the range bound market, the consolidating market, where the market isn't really doing much. It's just moving in like a box till it breaks out. If it breaks out to the downside, sellers should continue the market. If it breaks out to the upside, you might have more chances for buyers to step in, right? So we had a bullish run on Euro USD from here all the way to this place. Now this was the major reversal point, the major swing low for Euro USD. Look at it, price came all the way here, and the reversal, this bullish leg started from here. So this is a major swing low. Look at it. So this is a swing low. This low here is a swing low. Why is it a swing low? Because it reversed price, reversed the market up, right? Look at, the market was also buying here, buying, got to this place, reversed temporarily down. So this is a swing high. Those major reversal points where the market was either buying and came back down, or was either selling and went back up, those are swing points. You understand? So this is another word. This is a swing high. So this is a swing high. This is a swing low. So this is how you identify swing highs and swing lows on the market. This is a swing low. This is another swing point. This is a swing high. The market was doing what? Running a little bit, then dropped hard from here. So this is a swing high. This is a swing low. So there are multiple swing highs and swing lows on the market that you can identify. See, it's highs and lows, causing temporary reversal, temporary pullback, right? So those are swing points. So if you can go on, you can, to get better at it, you can go on your charts, look at those swing points and just highlight them out. So basically at those swing points, you can also use those swing points as your major S&R level, support and resistance level. So at this particular low now, this swing low, I can equally just say, okay, I mark an horizontal line here. You can put an horizontal line at the base. At this swing point here, you can put a horizontal line here. At this swing point here, you can put, look at this one, this swing low that caused a temporary reversal up. You can put an horizontal line. You're already marking your key levels. That's easy as that. Look at this swing high. You can put this one as well. Look at this swing points. You can also put, so now when you're marking your key levels, don't make it too rough. Don't make it rough. I don't use more than 4 lines just to make my work clean. So this is also a what? This is also a swing low. You can see, so this is also a swing low. I can equally just put my horizontal line there. Look at it. And this way I've been able to what? I've been able to identify my key levels effectively. Now let me take out all of these guys that I put here. Let me take these guys out. Let me take these guys out for a minute. All right, so this, I'll teach you different arcs how you can arrive at the same results. All right, so these are key levels. Easy. Now we said, how do you identify strong key levels, right? How do you identify strong key levels? We said multiple reactions around that level, large rejection candles, is on the higher time frame and has high trading volume around it. When your key level just has few reaction or just one touch, it's not a strong key level. Now let's look at examples here. Look at the amount of times. Look at this level we marked here. Look at the amount of times the market touched it and reacted. You can see from here, touched it, pushed up, touched it, pushed up, touched it, pushed up, touched it, came here, touched it, pushed up. So this is a strong key level. You can see. Look at this one we marked down. This one here. You can see the amount of time the market came there, came up here, reacted, went down. Came back up here, reacted, came down. Went above it. All of these things came back here, reacted, and pushed back up. So that is how you identify. Oh, once you mark your key level, you have to see the amount of reaction. If it is more than 2-3 touches, then you know that, okay, that is a strong reference point. Because these key levels are where institutional traders, I mean the people with large volume, large transaction volume, millions of dollars, these are the levels they look at when they want to trade. So this is how, look at this particular level we marked here as well. Market came there, reacted, came back there, reacted, came back there, reacted, pushed above it, came there, acted as what? Your support can also turn resistance, your resistance can turn support. This is what I mean. When the price is below those key levels, it can act, your key level can act as a resistance. When the price is above the key level, it can act as a support. So this is where the price of Euro USD currently is. Like we said, you can see it is below this key level here. So if this guy comes back here, this place can act as a resistance. It means you'll be expecting sellers to step in here and get active. In a situation whereby the sellers stepped in, but they weren't able to push the price down and the market breaks above this key level, you can expect the market to retest this area and continue buying. In a situation whereby Euro USD drops hard all the way to this key level and pushes up a little bit, and buyers couldn't really sustain the momentum and it goes back down, breaks below it cleanly, you can expect the market to retest. You know, it was a support initially. It becomes, when price breaks below it and the market comes back there, it becomes a resistance, a ceiling for price. The price will touch it, then go back to the next key level. So the market in essence moves levels to level. This is also another key level here. Look at this place. You can see the reversal here. So this is another key level. So this is one easy way to mark. Just look for the swing points where you know that, oh, okay, this price reversed from here on the higher time frame. Now, instead of using horizontal line, I just use rectangle. Once I've been able to use horizontal line to highlight those key levels, I just switch to horizontal. You can get all of these tools. They are all here. Look at it here. If you come here, you would see it: brush, highlighter, arrow marker. Look at it. These are all the tools you can. So I just start the ones I need and I place them here on my screen. You can see. So instead of using horizontal line, you know, we said line is too precise. Key levels are zones, so you have to mark it as a zone. You mark it like this. It doesn't have to be clean. It doesn't have to be crystal. You understand? You can just, it's just a zone you want to mark out. So I use green to denote my support. Green to denote my support if price is around it or above it. So this is my support. Take out this guy. So this area becomes my what? My resistance, because price is below it. You can see, so resistance. This place becomes my what? Becomes my, I'll teach you another technique to use. Becomes my resistance. Take this out. Take this out. This place also becomes my resistance. But the difference is, you can see this one is just one single touch. There are no multiple reactions around here, so I can just take this guy out. And these are my major key levels. You can see this reversal here as well. Look at the price came up, reversed, came up here. So I can equally still say this is a good level of support. Look at it. I can mark it like this, and I change the color to what? To green. So this is how you mark your key levels. So each time the market moves from level to level. If each time the market gets to that particular level, you want to see the reaction from buyers. That is where candlestick psychology comes in. You want to see how those candles react around there. Then you decide. Then you take your trades. You don't just, oh, the market is here, then you just buy. No. Oh, the market is here, you just want to sell. No. You look for reactions, signs of buyers, signs of momentum, signs of aggressiveness before you take the trade, right? So this one as well. So this is one technique you can use to mark your key levels effectively. Let me show you another example. Let's go to let's use USD card. So let's go to USD card. Let me show you another technique I use. So this is the daily time frame of USD card. you can see this. This is where the price is currently. So look at this bullish run here. You can see this bullish move here. This bullish run. So what price is currently doing is pulling back, because we in those previous sessions we talked about the markets running up and coming down to give other buyers entries, people that didn't catch it from the beginning, to give them entries, then to continue the major direction of the market. All right, so the other technique I use to mark my key levels is, this is currently candlestick we are on. So I change it from candlestick, I put it to line. You understand? So you can come here, candles, all of these things, I put it to line charts. So once I'm on line charts, then I zoom out. This is where the market is currently. Around that line chart, you can see what you just want to see is you want to see the reversal points, where the market reversed from. It's the same thing. Look at it here. I can see the market ran here, then came back down. So this is one reversal point here. You put your horizontal line. You pick another one. Okay, so the market came back down here, reversed again from here. This is another swing low. This is a swing high. This is a swing low. Right? You can see. Then you pick another line. Okay, so the market came up here all the way here, then reversed from here. Okay, I can say this is a swing high. I'm marking it around where price is. This is where price is. I'm not going far back and coming to market. No, I'm marking around where price is. Do you understand? So the market came up here, came down, and pushed up again. So this is another reversal point here. You mark it here. You understand? So I marked it around where the price is. If I want to go far back, then I can say, okay, let me mark other places as well. So the market came all the way down here, then pulled back, came up here. So this is another swing low. Then this is, you can see, came up here, came down, another swing low. You can see if you came up here, this is another swing high. So you can just do it like this. Then when you go far back, you see that those lines you marked, you see how the market respected it. Yeah, this is as far back as 2015 of April. Came here, bounced. Came back around it, bounced. Came back around it, bounced. Each time the market comes back to all of these support areas, it bounces up. Buyer steps in. They stepped in each time. So this is how you mark your. So then from there I can now change it to what? From line, I change it back to candles. Then I mark the zones like this. So you can mark the zones like this. Look at it. This is a support level. This is, if once price is above the area, is its support. If it's below, it is resistance. You can see it doesn't have to be clean. You just want to make sure that you highlight it perfectly. So this is another. You can see it here. So let me just take this out. Okay, no, I have to mark this one. So this is how you mark you align your key levels. Let me take this out. So the market is quite far to this place, so you don't really need these ones yet, but I just mark them out. So you remove all the horizontal line. So for this one here, because the market is already below this key level, it becomes your what? Your resistance. You understand? And this one also becomes your what? Becomes your resistance. The price is below it. So resistance, you change it to what? You change it to red. Resistance, you change it to what? You change it to red. So this is how, this is another key level here. Look at the price came here, reversed. So I can equally still say, mark this area out. You can see support. So this is how you highlight your key levels effectively, cleanly. It doesn't have to be too many lines jumbled up, jam packed now. Just around where the market is, just 3, 4, 5 lines, you are okay. Zones, right? Expecting reaction around there. So this is how you mark your key levels. Fix it. So then from the daily time frame, I switch to the H4. I start looking at the trend. Okay, so this is a bullish trend. I want to buy. I want to join the buyers. Then I start looking for entries from the pullback and all of it. But this is how you mark your key levels. You understand? When the market gets to resistance, wait for price action to confirm that, okay, sellers wants to step in when it comes to it. So that one is going to be in another session, another class. Okay, let me see. All right, so moving on. So we've talked about all of these things, our price reaction. So common beginner mistakes: drawing too many levels, using only 5 minutes charts, treating levels as exact prices, ignoring higher time frames, and trading every touch. You don't have to trade every touch. So these are common beginners mistake You have to always zoom out on the bigger perspective to see things. So dim golden rules, less is more. Mark only obvious levels with multiple touches. Daily time frame first. H4 time frame second for your structure and to refine it. You wait for confirmation around those levels. You never force a trade. Zones are much better than using lines. Quick checklist before you trade. Is this a daily or H4 level? Has price reacted here before? Am I trading a zone? Is there a confirmation? Is my risk managed? So focus on the process at all times. Control your emotions. Consistency creates results. So this is how you build a structure in trading. I wish I had all of these alignments when I started, but I didn't. I had to learn so many jargons and all of those things before I was able to align myself perfectly with the market. So yeah, so we'll end the class here. We'll end the session here. If you stayed through to the end of the video, you've done well. Thumbs up. And yeah, so we'll see on the next class. Stay active and stay sharp, guys. Bye for now.